Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. The US economy continues to surprise both optimists and pessimists. Inflation remains stubborn, interest rates remain elevated, and political uncertainty is rising as the 2026 midterm elections approach. Yet beneath the headlines, the American economy continues to demonstrate remarkable resilience. Consumption has slowed, but not collapsed. Business investment remains supported by an unprecedented wave of artificial intelligence infrastructure spending. Meanwhile, policymakers face an increasingly difficult balancing act between sustaining growth and preventing inflation from becoming entrenched. Throughout this presentation, we'll examine the latest economic indicators to understand where the U.S. economy is headed, what risks investors should monitor, and why structural forces, not short-term headlines, will ultimately determine the investment landscape. The first chart provides the broadest snapshot of the American economy by comparing quarterly GDP growth with year-over-year growth. The most dramatic feature remains the pandemic shock in 2020, followed by an extraordinary rebound as the economy reopened. But what matters today is not that historical volatility. Instead, investors should focus on the remarkable stability that has emerged afterward. Quarterly growth has gradually normalized around a moderate pace rather than collapsing into recession. Annual growth has become more cyclical, but continues to fluctuate within a relatively healthy range. Looking ahead, projections suggest quarterly GDP growth remains close to 2%, while annual growth moderates without turning negative. This is an important distinction. Many economists expected aggressive monetary tightening to produce a sharp recession. Instead, the economy appears to be transitioning towards slower but sustainable expansion. The resilience reflects several structural supports. Consumer spending remains positive. Labor markets continue generating income growth. Business investment, especially in artificial intelligence infrastructure, has offset weakness in more interest-sensitive sectors such as housing. From YCC Capital's perspective, this chart reinforces one of the report's central conclusions. The United States is no longer experiencing stimulus-driven growth. Instead, it is increasingly relying on productivity-enhancing private sector investment. That transition creates a healthier long-term foundation, even if headline growth becomes less spectacular. The economy may no longer be sprinting, but it continues to move forward at a steady marathon pace. Looking beneath the headline GDP number reveals what is actually driving economic growth. Personal consumption remains the largest and most consistent positive contributor. American households continue spending despite elevated borrowing costs, demonstrating that consumer demand remains remarkably resilient. Business investment also contributes positively, supported by corporate spending on technology, automation, data centers, and artificial intelligence infrastructure. Government spending provides modest support throughout most quarters, while inventories create temporary volatility as companies adjust stock levels in response to changing demand. Perhaps the most volatile component is net exports. Large swings in trade flows periodically boost or subtract from overall GDP. But these movements often reflect temporary timing effects rather than lasting economic trends. One particularly interesting feature appears in the projected quarters. Strong investment continues offsetting softer contributions from inventories and trade. This suggests future growth is expected to become increasingly investment driven rather than consumption driven alone. Historically, economies that depend solely on household spending become vulnerable when consumers pull back. Economies supported by productive business investment tend to enjoy more durable expansions because new capital eventually raises future productivity. This composition matters just as much as the headline GDP figure. Healthy growth is not simply about how fast the economy expands, it is also about where that growth comes from. High frequency indicators often detect economic turning points before official GDP data becomes available. The New York Fed Weekly Economic Index serves precisely that purpose. Although the weekly readings fluctuate considerably, the 13-week moving average tells a much clearer story. Economic momentum has steadily strengthened over recent months, rising toward levels consistent with annual GDP growth approaching 3%. Notice how closely the moving average follows the quarterly GDP trend shown in green. The relationship reinforces the usefulness of this indicator as an early signal of economic direction. Rather than pointing toward recession, current readings suggest continued expansion. This is particularly important because financial markets frequently overreact to isolated economic releases. Weekly employment data, retail sales, or manufacturing surveys can generate alarming headlines, yet the broader trend often remains intact. Like navigating through fog using multiple instruments instead of looking through a single window, professional investors rely on composite indicators rather than individual data points. At present, those indicators continue signaling that the economy is slowing only modestly, not contracting. That distinction helps explain why expectations for aggressive Federal Reserve rate cuts continue being pushed further into the future. Another widely respected leading indicator comes from the Chicago Federal Reserve. The National Activity Index combines dozens of economic variables into a single measure of overall activity. Values above zero indicate above trend growth, while readings below zero suggest below trend expansion. Following the extraordinary volatility during the pandemic, the index has largely oscillated around zero. More recently, however, the 3-month moving average has edged back into positive territory. This tells us something important. Rather than overheating or collapsing, the economy appears to be operating close to its long-term potential. That environment creates a difficult challenge for policymakers. Growth remains sufficiently strong to prevent recession, yet it also remains sufficiently healthy to keep inflationary pressures alive. For the Federal Reserve, this represents perhaps the most uncomfortable scenario. If economic activity refuses to weaken meaningfully, policymakers have little justification for aggressive monetary easing. From an investment perspective, this supports the report's higher for longer interest rate outlook. Markets may continue hoping for rapid policy easing, but the underlying economy simply does not appear weak enough to require it. The evidence increasingly supports patience rather than urgency. The OECD Composite Leading Indicator offers another valuable perspective by looking beyond current activity and focusing on where the economy is likely headed over the coming months. Historically, this indicator has been remarkably effective at identifying major turning points. It declined ahead of previous slowdowns, collapsed during the pandemic, then recovered as the economy reopened. More recently, after a temporary soft patch through 2023, the index has resumed a steady upward trajectory and now sits comfortably above the neutral level of 100. That is an encouraging signal. Leading indicators measure the economy's direction rather than its current speed. Much like seeing the road curve ahead before you reach it, they allow investors to anticipate changes before they appear in GDP or employment data. The recent improvement suggests economic momentum is gradually strengthening rather than fading. It also aligns with other indicators we've already examined, including the New York Fed Weekly Economic Index and the Chicago Fed National Activity Index. When several independent indicators begin telling the same story, investors should pay attention. For YCC Capital, the message is straightforward. The probability of a near-term recession remains lower than many market participants anticipated. Growth may continue moderating, but the broader economic cycle still points toward expansion rather than contraction. That outlook helps explain why we continue favoring high-quality U.S. assets supported by long-term structural growth instead of positioning for an imminent economic downturn. Retail sales remain one of the clearest windows into the health of the American consumer because household spending accounts for roughly two-thirds of the U.S. economy. This chart compares quarterly growth with year-over-year growth, and the picture is remarkably stable. Annual retail sales growth has moderated from the exceptionally strong post-pandemic recovery, but it has stabilized around a healthy range instead of collapsing. Quarterly growth remains somewhat volatile, yet most readings continue to stay positive. That tells us consumers are becoming more selective rather than dramatically reducing spending. Higher interest rates have certainly affected purchasing behavior. Financing costs are higher, excess savings accumulated during the pandemic have largely disappeared, and inflation continues to pressure household budgets. Yet employment remains strong enough to support continued consumption. Consumers today resemble disciplined shoppers rather than reckless spenders. They are paying closer attention to value, delaying discretionary purchases when necessary, but they have not abandoned spending altogether. This resilience has been one of the biggest surprises throughout the Federal Reserve's tightening cycle. Many expected sharply higher borrowing costs to trigger a meaningful collapse in consumer demand. Instead, household balance sheets and labor market strength have provided an important cushion. As long as consumers continue spending, even at a more measured pace, the broader economy should remain supported. Breaking retail sales into individual categories provides a much clearer understanding of changing consumer behavior. Core retail sales, shown in blue, have steadily accelerated and now represent one of the strongest components of consumer spending. Motor vehicle sales, shown in green, remain considerably more volatile because automobiles are highly sensitive to financing costs and replacement cycles. While demand fluctuates from month to month, the longer-term trend remains constructive. Meanwhile, food services and restaurants, represented by the red line, have gradually normalized after the extraordinary surge that followed the reopening of the economy. Notice that restaurant spending has slowed significantly from double-digit growth rates toward more sustainable levels. This normalization should not necessarily be interpreted as economic weakness. Instead, it reflects consumers returning to more balanced spending patterns after several years of unusually strong demand for travel, dining, and leisure activities. Core retail activity continues strengthening while more discretionary categories gradually cool. That combination is generally consistent with a mature economic expansion rather than the beginning of a recession. Consumers are prioritizing essential purchases, maintaining healthy overall spending, and becoming more deliberate about discretionary expenditures. From an investment standpoint, businesses offering clear value, essential products, and differentiated services are likely to outperform sectors that depend heavily on abundant consumer liquidity. High frequency data allows investors to monitor consumer activity almost in real time. The Redbook Retail Sales Index measures weekly same store sales across major retailers, providing one of the earliest signals of changing consumer demand. The recent trend is striking. Both the weekly readings and the 3 month moving average have accelerated meaningfully, reaching some of their strongest levels in recent years. Although weekly figures naturally fluctuate, the moving average smooths out short-term volatility and highlights the broader trend. That trend points upward. This suggests consumer spending has maintained considerable momentum despite persistent inflation and elevated borrowing costs. Importantly, high-frequency indicators like Redbook often provide confirmation before monthly government retail sales data becomes available. When both official statistics and private sector measures tell the same story, confidence in the underlying trend increases substantially. For investors, this reinforces an important conclusion. The American consumer has certainly become more disciplined, but discipline is not the same as weakness. Spending remains sufficiently healthy to support economic growth while becoming increasingly focused on value and necessity rather than excess. That balance continues reducing recession risk while supporting the broader economic expansion. Moving from retail sales to personal consumption expenditures gives us an even broader view of household demand. Unlike retail sales, which primarily capture purchases of goods, personal consumption expenditures include both goods and services, making this one of the Federal Reserve's preferred measures of overall consumer activity. The chart compares quarterly growth with year-over-year growth, and the longer-term trend is quite revealing. Following the extraordinary volatility during the pandemic, annual growth has steadily normalized. Instead of collapsing, spending has settled into a sustainable range of roughly 1.5% to 2%. Quarterly growth has also stabilized, with only modest fluctuations from one quarter to the next. This tells us that American households are still spending, but they are doing so at a much more measured pace. The era of stimulus-fueled consumption is clearly behind us. Fiscal transfers have faded, excess savings have largely been depleted, and consumers are increasingly relying on wage income rather than government support to finance spending. That transition is actually a positive development. Economic expansions built on rising employment and stable income are far more durable than those fueled by temporary stimulus. While the pace of consumption has slowed, its quality has improved. For the Federal Reserve, however, this creates a policy dilemma. Consumer demand remains sufficiently healthy to support economic growth, yet it also prevents inflation from falling rapidly back to target. As long as households continue spending steadily, businesses retain pricing power, particularly across labor-intensive service industries. From YCC Capital's perspective, This reinforces our higher for longer interest rate outlook. The economy simply has not weakened enough to justify aggressive monetary easing. Instead, policymakers are likely to maintain a restrictive stance until they gain greater confidence that inflation has been fully contained. Ultimately, this chart reinforces a broader theme running throughout the report. The US consumer has become more disciplined, not distressed. That distinction is one of the key reasons why the American economy continues to outperform expectations, despite one of the most aggressive tightening cycles in decades. While the previous chart focused on nominal consumer spending, this chart adjusts for inflation to show what households are actually purchasing in real terms. That distinction is extremely important. Consumers may spend more dollars simply because prices have increased, but real personal consumption tells us whether Americans are buying more goods and services after accounting for inflation. The encouraging news is that real consumption remains firmly positive. Following the sharp swings during the pandemic, year over year, real consumption has settled into a stable range of roughly 2 to 3%. Quarterly growth has also normalized, indicating that households continue expanding their purchasing activity despite higher prices and elevated interest rates. This highlights one of the defining characteristics of the current economic cycle. Inflation has undoubtedly reduced purchasing power, but it has not overwhelmed household demand. Rising employment, steady wage growth, and a resilient labor market have continued supporting real consumption. That helps explain why recession forecasts have repeatedly been pushed back. Historically, sustained declines in real consumer spending often precede major economic contractions. We simply are not seeing that pattern today. Instead, consumers are adapting. They are becoming more price conscious, searching for better value, and adjusting spending habits without significantly reducing overall consumption. For policymakers, however, this resilience creates another challenge. As long as real demand remains healthy, businesses have less incentive to aggressively cut prices, particularly across labor intensive service industries. That means inflation may continue, easing only gradually, rather than falling rapidly back toward the Federal Reserve's target. From YCC Capital's perspective, this chart reinforces the view that economic growth remains fundamentally supported by private sector demand. The consumer has slowed, but the consumer has not stopped. Perhaps no chart better illustrates the transition from the pandemic economy back to normality than household excess savings. During the pandemic, massive fiscal stimulus combined with restricted spending opportunities caused American households to accumulate an unprecedented stockpile of excess savings. At its peak, cumulative excess savings reached extraordinary levels, providing consumers with a substantial financial cushion. Over the following several years, however, that cushion has steadily disappeared. The purple line shows cumulative excess savings falling consistently, eventually turning negative as households fully exhausted the surplus accumulated during the pandemic. Meanwhile, the annual change in excess savings has remained negative for an extended period, indicating consumers have been drawing down savings rather than adding to them. At first glance, this might appear concerning, but it is important to place the data in context. The blue bars represent the long-term savings trend that would have existed even without the extraordinary distortions created by the pandemic. In many respects, the economy is simply returning to a more normal savings pattern rather than entering a period of financial distress. The key takeaway is that the consumer can no longer rely on excess liquidity to support spending. Going forward, consumption will increasingly depend on employment, wage growth, productivity improvements, and real disposable income rather than leftover pandemic savings. This transition marks an important shift in the economic cycle. The stimulus driven phase of the expansion is over. The next phase will depend on the underlying strength of the private sector. From YCC Capital's perspective, that is ultimately a healthier foundation. While consumer spending may become somewhat slower and more selective, an economy supported by productive investment, rising incomes, and genuine productivity gains is far more durable than one sustained by temporary fiscal stimulus. That is why we continue to believe the US economy remains resilient despite elevated interest rates. The sources of growth are changing, but the expansion itself remains intact. The data tells a remarkably consistent story. The US economy continues to slow gradually, not abruptly. Consumers remain resilient despite exhausting pandemic savings. Business investment, particularly in artificial intelligence infrastructure, continues supporting long-term productivity growth. Inflation is easing, but persistent service sector pressures suggest interest rates are likely to remain higher for longer. As the 2026 midterm elections approach, political headlines will undoubtedly generate market volatility through trade policy, tariffs, and geopolitical developments. However, history reminds us that long-term investment returns are ultimately driven by structural fundamentals rather than daily headlines. At YCC Capital, we continue to believe disciplined investors should focus on enduring trends, productivity, innovation, resilient corporate investment, and high-quality assets, while remaining selective, valuation conscious, and attentive to inflation risks. Thank you for watching. If you enjoyed this research, please subscribe to YCC Capital Macro Research for more in-depth analysis of the global economy, financial markets, and the structural forces shaping tomorrow's investment landscape. We look forward to seeing you in our next report.